Welcome to the deep dive. Today we're tackling related party disclosures. Now that might not sound, like the most thrilling topic, but stick with us because understanding these disclosures is absolutely key to truly grasping what's going on beneath the surface of a company's financial reports.
That's right. Think of it as getting a look at the connections a company has with its inner circle, its parent company, its subsidiaries, the folks at the top, and even their close families. These connections can lead to deals and arrangements that wouldn't necessarily happen with unrelated businesses.
Exactly. And that's where these disclosures come in. For this deep dive, we've pulled together a really interesting set of sources tailored just for you. We're looking at accounting rules from different parts of the world, IAS 24, which is an international accounting standard, then the Australian Accounting Standards Board's version, AASB 124, and New Zealand's take with NZIAS 24.
Yeah, and plus we've got some sharp analysis from the CFA Institute, especially focusing on how related party transactions play out in Asia and even some regulatory viewpoints. So we're getting a really, well-rounded picture.
Our goal today is basically to make sense of all this without getting lost in accounting jargon. We want you to understand why these disclosures matter, what kind of potential problems they can highlight, and what safeguards are supposed to be in place to protect investors.
Okay, let's unpack this. First things first. What exactly are we talking about when we say related parties and related party transactions?
A good starting point.
Well, according to IAS 24, that international accounting rule we mentioned, a related party is essentially a person or entity that is connected to the company that's preparing its financial statements. Now, this connection can take several forms.
Can you give us some examples of who could be considered a related party, like who falls into that bucket?
Sure. The most obvious examples are a parent company and its subsidiaries. But it also includes what are called fellow subsidiaries. These are companies that share the same parent. Then you have associates and joint ventures.
Okay.
Think of companies where your main company has a strong say in decisions. That's what's meant by significant influence. Or where it jointly makes decisions with another company. That's joint control. And crucially, it also includes key management personnel. These are the people who have the authority and responsibility for, running the company.
Right, the top brass.
And it doesn't start there.
So it's not just the CEOs and top executives then.
That's right. It extends to close members of their families as well. IAS 24 clarifies that this generally includes children, spouses, or domestic partners and dependents. The key idea here is the potential for influence.
Okay.
Could this family member influence or be influenced by the key manager in their dealings with the company? It really comes down to looking at the level of potential sway in each situation.
Okay, so it's not just about legal structures or job titles, but also these personal connections and the possibility of one person's actions being influenced by another. That makes sense. Now, what about the transactions themselves? What counts as a related party transaction?
Right. A related party transaction is any transfer of resources, services, or obligations between these related parties. And this is a really important point. It doesn't matter if money actually changes hands or not.
Really? Even if nothing's paid?
Yeah. Even something like a free service provided to a related party is considered a related party transaction.
That makes sense. So it's much broader than just buying and selling goods.
Absolutely. The accounting standards, like IAS 24 and the CFA Institute report, give us a good list of examples. This can include buying or selling goods or property, providing or receiving services like accounting or consulting, leases, loans, guarantees where one party backs the debt of another,
Guarantees, okay.
and even things like transferring research and development or licensing agreements. Pretty broad.
Wow, that covers a lot. Even something like a parent company guaranteeing a loan for its subsidiary would be a related party transaction.
Exactly. And as the Australian standard ASB 1-124 points out, even if there are no actual transactions, just the existence of a related party relationship can affect a company's profit and loss and its overall financial situation.
How can that be if no money is being exchanged? That seems counterintuitive.
Well, think about it like this. A subsidiary might decide to end a perfectly good business relationship with another company simply because its parent company bought a competitor of that other company. No transaction occurred between the subsidiary and its parent regarding this, but the parent's action directly impacted the subsidiary's business.
Ah, I see. So it's indirect influence.
Precisely. Or a parent company could tell its subsidiary not to pursue a promising research project because it clashes with the parent's own plans. Again, the relationship influences decisions, even without a direct transaction between them.
Okay, That really highlights that it's not just about the specific transactions, but the broader influence these relationships can have on a company's operations. So, with all this in mind, why are these related party disclosures actually necessary? Why should an investor, like, someone listening, care about them?
Here's where it gets really interesting. The core reason these disclosures are so important is that related parties might enter into transactions that completely unrelated parties simply wouldn't consider. Or they might agree to terms that are very different from what you'd see in an open market deal.
Like preferential treatment.
Exactly.
Hmm.
For example, as IAS 24 mentions, a company might sell goods to its parent company at just the cost to produce them, something it would almost certainly never do for a regular independent customer.
Right. It's not a level playing field when you're dealing with related parties, is it?
No, not at all. This creates a significant potential for conflicts of interest when insiders are dealing with each other, as the CFA Institute report really emphasizes. While related party transactions can have legitimate business reasons, things like internal reorganizations or sharing services efficiently,
Ah,
they can also be used, particularly in regions where a few people or families control many businesses, like in parts of Asia, as a way for those dominant shareholders to essentially move wealth away from the smaller minority investors.
that sounds pretty concerning. Can you give us a clear picture of how that might happen? Like, what are the actual mechanisms?
Sure, the CFA Institute report shares some really telling cautionary tales. Imagine a publicly listed company buying an asset from a private company that's owned by the same controlling shareholder, but at a price that's far higher than what that asset is actually worth.
Yep.
Yeah, that's a direct transfer of value from the public company and its shareholders to the private company and the controlling shareholder. It's like the company is overpaying itself using shareholder money, directly impacting shareholder value by potentially diluting earnings per share and, reducing the value of the company's assets.
So it's direct hit to the investors.
Right. Or consider a company providing loans or guarantees to a struggling related company. If that related company can't repay, the healthy company and its investors are the ones who suffer the loss. At its worst, these transactions can even be used to hide outright fraud.
Wow. The CFA Institute report also touched on the Asian financial crisis of 1997. How did related party transactions contribute to that whole mess?
Yes, that crisis really highlighted the dangers. Many businesses in Asia were controlled by families who often pursued rapid expansion using a lot of borrowed money, and these borrowings and investments often flowed within their own network of related companies.
Kind of keeping it all in the family, financially speaking.
Sort of, yeah. But when the value of their currencies dropped sharply, these heavily indebted companies couldn't repay their loans. Because so many of these companies were interconnected through lending and guarantees within the related party network, the failure of one could quickly spread to others, a real domino effect.
A systemic risk, then.
Absolutely.
Hmm.
Minority shareholders often saw the companies they invested in engaging in questionable cash transfers, taking on each other's debts and buying assets from each other at inflated prices in a desperate attempt to stay afloat, leaving little for the outside investors. This really demonstrated how interconnectedness through related party dealings can create systemic risk, where the failure of one entity can quickly cascade.
The report even mentioned some specific historical examples, didn't it? Like the Sinar Mass Group and the Rebar Group. Those sounded pretty bad.
Yes, those are really clear examples of how problematic related party transactions can lead to major corporate collapses. In Indonesia, one of the listed banks within the Sinar Mass Group failed under the weight of huge loans it had made to its own subsidiaries. And in Taiwan, the Rebar Group saw two of its listed companies go bankrupt after the main shareholder allegedly moved billions of dollars through related entities. These aren't just theoretical risks. They've had very real and damaging consequences for investors.
So the disclosures are really about bringing these potential risks and conflicts of interest into the open, risks that you wouldn't necessarily see just by looking at the company's dealings with independent parties.
Okay.
Now, if a company does have these related party relationships and transactions, what specific information do they actually need to disclose? What are the rules around that?
According to IAS 24, the main idea is that companies have to disclose the nature of their related party relationships and give enough information about their transactions and outstanding balances, including any commitments they've made, so that anyone looking at the financial statements can understand how these relationships might be affecting the company's financial position and performance.
Okay, so it's not just a simple yes or no question of whether they have related parties. They need to provide details. What kind of details are we talking about? Like, how granular does it get?
At a minimum, they need to disclose the total amount of the transactions, any balances owed between the related parties at the end of the reporting period, and the terms and conditions associated with those balances.
Terms and conditions, too.
Yes. So, for example, if a company has made a loan to a related party, the disclosure should probably mention the interest rate, when it's due to be repaid, and whether any assets have been pledged as security. The important stuff.
What about those key management personnel we talked about earlier? Is their pay part of these disclosures? That seems like sensitive info.
Absolutely. IAS 24 specifically requires companies to disclose the compensation paid to those in key management roles, both the total amount and how it breaks down into different categories.
Categories like what?
This includes things like their base salaries, bonuses, retirement benefits, any long-term incentives, payments they receive if their employment ends, severance packages, and even things like stock options or shares they might have been granted. This kind of transparency is really important for investors to judge whether the executives are being paid fairly, in relation to the company's performance and the interests of the shareholders.
Right. We also saw that the Australian accounting standard, AASB 124, initially had a specific exemption for not-for-profit public sector entities. What was the thinking behind that? Seems odd.
Yeah, initially AASB 124 did have an exemption for these types of organizations. It was largely due to practical concerns about the sheer volume and complexity of transactions that can occur within government and between different government-controlled entities. It could be a huge burden.
I can imagine.
However, it's important to know that this blanket exemption is no longer in place for the general-purpose financial statements of these entities. There was a growing recognition that providing relevant information about related party dealings, especially concerning the compensation of key management personnel, is a crucial aspect of public sector accountability.
Okay, so that changed. What about government-related entities more broadly? IAS 24 seems to have some specific things to consider for them, right?
That's right, because government-related entities often have a huge number of relationships with other government entities, ministries, departments, other state-owned companies. IAS 24 acknowledges this and provides a partial break, a sort of relief, from the full disclosure rules in paragraph 18.
A break? How so?
Well, if a company is controlled, jointly controlled, or significantly influenced by a government, it doesn't have to disclose every single transaction it has with other entities that are also under the control of the same government.
That sounds like it could potentially hide a lot of information, though. What are the conditions for that exemption? Are there guardrails?
There are still important disclosure requirements, even if they use this exemption. They absolutely must disclose the name of the government that controls, jointly controls, or significantly influences them, and they have to describe the nature of that relationship.
Okay, that's something.
Crucially, they also have to provide enough information about their transactions and any outstanding balances with other government-related entities so that users can still understand the overall impact on their financial statements. This includes disclosing the details and amounts of any individual transaction that is significant on its own.
Right, the big ones.
And also giving a general idea, either in words or numbers, of the total extent of other transactions that might not be significant individually, but are important when you add them all up. Collectively significant, they call it.
So even with this break, the really big and important stuff still needs to be visible. They can't just sweep everything under the rug.
Exactly. And as both IAS 24 and guidance from organizations like Audit Scotland emphasize, the concept of materiality is always key in deciding how much detail needs to be disclosed. Small, unimportant transactions don't need pages of explanation, but anything that could reasonably influence the decisions of people using the financial statements needs to be clearly presented.
Makes sense. Materiality is always a factor.
And one more point on disclosure. It's worth remembering that if a company claims that a related party transaction was conducted on arm's-length terms, meaning it was priced as if it were with an independent party, they can only say that if they actually have evidence to back that up. They can't just make the claim without proof.
Right, they need to substantiate it.
Mhm.
Okay, so we've got a handle on what related parties and transactions are, why we need to know about them, and what information has to be disclosed. Now, let's talk about how investors are actually protected from potentially dodgy related party deals. What safeguards are in place?
Okay, yeah. There are several layers of protection designed to address this, as the CFA Institute report outlines pretty well. The first, and most fundamental, is simply the existence of accounting standards like IAS 24 that mandate these disclosures. At the very least, this shines a light on these transactions. Transparency is the first step.
But just knowing about them isn't enough to stop abuse, is it? Like, seeing it doesn't prevent it.
You're absolutely right. That's where the second layer comes in. The rules set by stock exchanges for companies that are listed on them. These listing rules often have specific thresholds for related party transactions.
Thresholds based on size.
Exactly, based on financial size relative to the company. And if a transaction exceeds these thresholds, the company might be required to get approval from its shareholders. Importantly, related parties themselves are often not allowed to vote on these approvals.
Ah, so the conflicted parties can't vote in their own favor.
Precisely. For example, the CFA Institute report mentions that in Hong Kong and China, if a related party transaction exceeds certain financial benchmarks, it triggers the need for a shareholder vote, with the related parties having to abstain.
So the smaller shareholders, the minority investors, get a say on the really big deals that could potentially benefit the insiders.
In theory, yes. That's the idea. The third layer of protection is the crucial role played by independent directors and the audit committee. These individuals are supposed to review related party transactions to make sure they are fair to all shareholders, not just the controlling ones.
The independent oversight?
Yes. In many places, including across Asia, regulations require listed companies to have a minimum number of directors who are independent and an audit committee made up of mostly or entirely independent members.
And what about inside the companies themselves? Are there any internal checks and balances they're supposed to have?
Absolutely. The fourth layer involves the company's own internal corporate governance systems. This can include things like keeping a record or a register of all related party transactions. Sometimes these registers are even open for shareholders to inspect, which is interesting.
Didn't know that.
And having specific committees within the company, maybe separate from the audit committee, that are responsible for reviewing these kinds of deals before they happen.
And if all these safeguards fail, the disclosures, the listing rules, the independent directors, the internal controls, do investors have any way to seek justice? Any recourse?
Yes, the fifth layer is the possibility of shareholders taking legal action. If minority shareholders believe that the company's directors have acted improperly, including through unfair related party transactions, they can sometimes go to court to seek remedies, like damages.
Like a lawsuit.
It's exactly. However, as the CFA Institute report points out, actually succeeding with these kinds of lawsuits can be difficult. There are legal complexities, it costs a lot of money, it takes a lot of time, all of which can sometimes discourage shareholders from actually pursuing them, even if they feel wronged.
Right. It sounds like there are quite a few protections in place on paper, but the CFA Institute report also points out some challenges in making them truly effective in practice. What are some of the main obstacles?
Yeah, there are definite challenges. One big one is simply identifying all the related parties, especially in complex business structures that might involve numerous private companies, maybe offshore entities. It can get murky.
Hard to follow the trail sometimes.
Very. Auditors often have to rely heavily on the company's management to disclose these relationships. And if there's a deliberate attempt to hide a questionable transaction, well, that disclosure might not happen.
So reliance on management honesty is a weak point.
It can be. Another issue is the possibility of rubber stamp independent directors. These are individuals who might be technically independent according to the rules, but in reality are too closely tied to or influenced by the controlling shareholders, maybe due to past connections, friendships, or other loyalties. They might not push back hard enough.
Just nodding things through. The report also mentioned that in some Asian markets, just looking at the regular financial reports, like the annual or semi-annual ones, might not be enough to catch these issues early on. Why is that?
That's a really important practical point. Unlike in some other regions like the U.S., where companies report quarterly financial statements pretty comprehensively, including related party disclosures, in some Asian markets, the regular interim reports, the ones between the big annual reports, can be quite brief, sometimes just summarize figures.
Less detail.
Much less detail. So, investors often need to be more proactive and look at other filings with the regulatory authorities and announcements made by the listed companies on the stock exchange websites to get more timely information about significant related party deals as they happen, rather than waiting months for the next full report.
So more legwork required for investors in those markets. Okay. What are some of the things that are being done or recommended to improve transparency and regulation in this area, particularly in Asia, where the CFA report focused?
Well, the CFA Institute makes several recommendations for improvement. These include setting clearer and more specific rules, maybe bright line tests for what level or percentage of related party transactions requires disclosure and shareholder approval, making it less ambiguous.
More objective thresholds.
Yes. Also, requiring independent financial advisors to provide valuations for significant related party deals to ensure they're fair from a financial perspective. Get a third-party opinion on the price.
That seems sensible.
And working to increase both the number and the genuine independence of company directors. Maybe stricter definitions of independence or longer cooling off periods. There's also a push for companies to be more transparent about their related party relationships overall, perhaps even voluntarily disclosing the identities and ownership structures of their key related parties and their subsidiaries, even if not strictly required, just better maps of the corporate group.
Interesting. We also touched briefly on the situation in Bangladesh with the mention of the SEC, ICB, and DSE. What's happening there specifically?
Yeah, the analysis we looked at, focusing on how IAS 24 is applied in Bangladesh, showed that, particularly among insurance companies, many aren't doing a great job of following the standard. Compliance was patchy.
Really?
It could be a mix of reasons, maybe lack of expertise, maybe weak enforcement. Regulatory bodies like the Securities and Exchange Commission, SEC, the Institute of Chartered Accountants of Bangladesh, ICAB, and the Dhaka Stock Exchange, DSE, clearly have a crucial role to play in making sure companies comply. But the research suggests that there's a need for stronger enforcement of the existing rules and possibly more specific guidelines tailored to the local context for a related party disclosure to really raise the bar for financial reporting quality there.
So the rules might be there, but the follow-through needs work.
Seems like it, yeah.
And finally, we saw that the Reserve Bank of India's guidelines for non-banking financial companies, the NBFCs in India, also reflect a growing focus on these disclosures, right?
Yes, absolutely. The RBI has been increasingly emphasizing the need for these financial institutions, which are really important in India's economy, to provide more comprehensive disclosures of their related party transactions in their financial statements. It's about bringing them more in line with the accounting standards and the regulations that already apply to listed companies. This really indicates a wider global trend towards greater scrutiny and transparency in this area. It's not just an Asian issue.
Right, a tightening up everywhere. Okay, wow, we covered a lot today. To sum up then, related party disclosures are really about understanding the network of connections a company has and how those connections could be influencing its financial dealings, for good or ill.
Exactly. They're vital for identifying potential conflicts of interest and helping to ensure that controlling shareholders aren't unfairly benefiting at the expense of other investors, the minority shareholders.
And while we have regulations and accounting standards like IAS 24 aimed at providing transparency and protecting investors, the risk of abuse is still definitely there, particularly in certain types of ownership structures like family-controlled groups and perhaps more prevalent or harder to spot in some regions.
Absolutely. And as we've discussed, these disclosures aren't just some technical accounting requirement you tick off a list. They can provide really important clues about a company's financial health, its governance quality, and maybe even the trustworthiness of its management.
Yeah, those historical examples of corporate failures linked to dodgy related party transactions, Sinar Mas, Rebar Group, they really serve as a stark reminder of just how critical these disclosures can be, don't they?
They really do. Big warning signs.
So considering all this complexity and the potential for hidden influence, here's something for you, our listener, to think about. For an individual investor who might not be an expert in accounting, how can they really use related party disclosures effectively to make informed decisions about where to put their money? It's not always straightforward.
That's the key question, isn't it?
And maybe what additional steps could regulators realistically take to make this information more valuable and, crucially, easier to understand and digest for the average investor? Because just dumping data isn't always helpful. It definitely makes sense, though, to take a closer look at those company financial statements and regulatory filings with a more critical eye, specifically looking for these related party sections.
Absolutely. Dig a little deeper. And on that note, we wrap up this deep dive. Thanks for joining us.